Hello and welcome back to the Deep Dive. It is, the last Tuesday of 2025. We are so close to the new year, but we've got one more for you.
One final deep dive for 2025, and then a quick break before we're back for 2026.
Exactly. Thanks for sticking with us all year. Today, we're looking at a huge global market that, feels a bit stuck right now. The United Kingdom.
Yeah, that's a good word for it, stuck. As we head into 2026, markets are looking for dynamism, but the UK is. Well, it's a complicated picture. A listener tracking international investments sent over a bunch of sources that aren't screaming five-alarm fire, but they're describing something else.
A kind of slow, corrosive stagnation. I saw the term in the analysis. They're calling it a fragile stasis.
Fragile stasis, that's it, exactly.
And that distinction really matters, doesn't it? Because the UK technically, it avoided a deep recession after that whole 2022-23 inflation mess. The headlines made it sound like they were in the clear.
Right, but the sources we have argue that this narrow success is just masking a much deeper structural problem.
A trap.
A trap, yeah. One of chronic high debt and just incredibly low productivity. So for our listeners, the UK is really at a macroeconomic crossroads, and it looks very different from most of its G7 peers right now.
Okay, so that's our mission today. Let's unpack this paradox. Why, despite some, on-paper aggregate growth, the average person in Britain isn't feeling any richer, and what that means for long-term risk.
The core of it, the one number that really tells the story, isn't that headline GDP figure? The 2024 number was, an anemic 1.1%?
Yeah, barely there.
The real story is the huge gap between that aggregate number and the per capita prosperity.
The growth is being, let's say, artificially inflated.
Precisely. It's not coming from people being more efficient or making more stuff. It's almost entirely from historic levels of net migration. The economy is getting wider, not richer, just adding more people.
So let's look at the latest snapshot we have, the numbers from Q3 of 2025. Aggregate GDP growth actually slowed down.
It did. It hit a microscopic 0.1% for the quarter, down from an already tiny 0.2% in Q2, a statistical noise, basically.
It's barely above zero. But that's where the structural failure becomes just so clear. When you factor in the population growth.
This is the real aha moment.
Yeah. For anyone looking at UK consumer strength, here it is. Real GDP per capita. So the actual measure of how much richer the average person is getting.
Showed 0.0% growth in Q3.
Zero. A flat zero. The sources confirm it. The average UK citizen is not significantly richer today than a year ago. It's basically a lost decade and a half since the 2008 crisis.
And you can see that gap so clearly in the graphs. If you set pre-pandemic wealth at 100.
Right, back in 2019.
Aggregate GDP is now up around 105. Looks like a recovery. But the real GDP per capita number, it's stuck at 99.6.
So below where it was in 2019.
Exactly. The pie hasn't really grown. We're just cutting the same pie into more slices for more people.
So you have zero real growth for the average person, and at the same time, inflation is still a problem. What's the latest there?
The Bank of England is facing what they're calling sticky resistance. The metric analysts are watching, CPIH.
That's the one that includes housing costs, right?
Right. A better measure of domestic pressure. It was still at 3.5% in November. That's nearly double the bank's 2% target.
And that's even with energy prices having come way down. So why is it so sticky?
Because the problem isn't imported energy anymore. That's down 25% from the peak. The problem is, moved inland. It's now a domestic structural inflation driven by the service sector and labor costs. And that's much harder for a central bank to fix.
And so the Bank of England, what's their play? They've cut rates a tiny bit.
Very cautiously. They brought the bank rate down to 3.75%, but that's still restrictive in real terms. They know they can't ease up too much while those domestic pressures are there.
So they're successfully cooling demand.
But the cost is killing any real growth for the population. Private consumption only grew 0.1%. A painful trade-off.
Okay, that trade-off leads us right to the government's balance sheet. Let's shift from the individual to the state's budget problems. How is the UK funding itself?
Fundamentally, it's caught in a debt trap. Public sector debt is hovering right around 100% of GDP. That's historically very high.
And it means a huge amount of money is just going to service that debt, not into investment.
A truly massive amount, the interest payments. They topped £100 billion a year in 23-24 and again in 24-25.
£100 billion. So what does that mean in practical terms?
It means that for every £10 the government spends, one of those pounds goes only to paying the interest. Not to hospitals, not to roads, just interest.
To put that in perspective, the sources say that's about 4 times the entire budget for nursing salaries.
It's a gigantic crowding out effect. It just hollows out the state's ability to invest in the future.
And there was that move earlier this year, the chancellor modifying the fiscal rules, the so-called Reeves rule. What was that about?
It was an attempt to create some wiggle room on paper. They changed the target they were measuring from traditional net debt to something called PSNFL.
Which excludes some Bank of England assets.
Exactly. So it made the debt number on the scoreboard look smaller without actually reducing the debt. The market saw right through it. They called it financial engineering.
And you can see that skepticism priced right into their bonds. UK gilts, their 10-year bonds, are yielding around 4.7%.
That's the highest in the G7. There's a structural risk premium baked in because investors are just not convinced.
Okay, so if we connect that fiscal stress to the private sector, this is where we get to what the analysts are calling the capital strike.
That's the term, yeah. The UK has basically lost its competitive edge for attracting long-term business investment.
And why is that? Why is capital on strike?
The analysis points to a few things. First, just a lot of regulatory uncertainty after Brexit. Second, corporate taxes are high compared to rivals like Ireland. And third, there's no certainty about access to skilled labor because of the shifting immigration policies.
And the result is that since 2016, business investment has just been flat.
Completely flat, paralyzed. Meanwhile, you look at the US, France, Italy, they all saw robust investment recoveries.
And you see the result in the headline numbers. The U.S. economy grew 13.3% from before the pandemic to Q2 of this year.
Right, thanks in part to things like the IRA. The UK over that same period grew just 5.2%.
And when you combine that tiny aggregate growth with the high population growth,
You get that zero point 0.0 individual wealth gain we talked about. The capital strike is probably the biggest self-inflicted wound here. It just guarantees low productivity.
all right, if you're finding this deep dive valuable, we'd like to invite you to subscribe to the channel, drop us a like, and please comment on what other global topics you'd like us to tackle next.
And in the description for this deep dive, you're going to find two important links. There's one to our sponsor, Broker360, and another one to PayPal if you feel like supporting this project.
We're not asking for more than the cost of a coffee, but honestly, every contribution really helps us continue making independent content just like this. Thank you for your support, and now let's get back to it.
Okay, so let's dig into the really deep-seated problems, the things that were there long before this current cycle.
Productivity, the real engine of living standards. And the sources call the UK's engine broken.
That's a fair description. UK productivity, that's output per hour, is about 20% lower than in the US, and it's growing at just 1.1% a year right now.
Which is way below its historical average of 2%, right?
Far below. So we talked about the capital strike, the fact that British workers just have fewer and worse tools, less deep capital than their German or French peers.
But there's another factor that's kind of unique to the UK, isn't there? The health of the workforce itself.
This is huge, and it's often overlooked. There are 2.8 million people now classified as economically inactive because of long-term sickness.
2.8 million, that's a staggering number. And the impact goes beyond just paying benefits.
It creates a really vicious cycle. You have this massive pool of people who are not working, which shrinks your productive capacity. At the same time, it increases demand for expensive healthcare benefits, which feeds right back into that fiscal fragility we discussed.
And on top of that, you've got these long-standing issues with infrastructure and bureaucracy.
Absolutely. A really restrictive planning system makes it incredibly hard to build new labs, new factories, or, crucially, new housing in the most productive places, like around Oxford, Cambridge, and London.
The Golden Triangle.
Exactly. And that feeds into this massive regional inequality, the North-South divide, which acts as a huge brake on the whole country's growth.
You can see it in the investment figures, can't you?
Oh, clearly. Over the last decade, public transport investment in London was over £1,100 per person. In the north of England, it was just $486.
Less than half.
And that lack of connectivity means cities like Manchester, Leeds, and Liverpool can't really function as a single, large, integrated labor market that could truly compete on a global scale.
And of course, looming over all of this is Brexit. The OBR, the official forecaster, still calls it a slow puncture on the economy.
Their forecast hasn't changed. They still project it'll reduce the UK's long-term trade intensity by about 15%. But what's really fascinating is the structural shift we're now seeing in the trade data.
A bifurcation, I think the sources called it.
A major one, between goods and services. Exports of high-value services, things like fintech, consulting, high-end tech, they're doing great, up 12% from 2019 levels.
Because they're less affected by customs checks and things like that.
Right. But exports of physical goods have collapsed. They're running 10% below 2019 levels.
So the UK is basically abandoning industrial capacity.
It seems so. It's becoming a very unbalanced economy, hyper-specialized, and dangerously reliant on that strong service sector to pay for a massive trade deficit and everything else.
Okay, let's turn to the final pillar holding this whole structure up, which is also maybe its biggest political flashpoint: migration.
Yeah, the sources are clear on this. Migration is the politically precarious element holding the entire system together. Net migration is still high, around 350,000 a year, but the makeup has changed completely.
It's not EU freedom of movement anymore.
Not at all. It's now heavily dominated by non-EU visas, especially for the health and social care sectors.
And the dependency there, particularly on the National Health Service, the NHS, is just critical.
It is a structural dependency. The health system would seize up without it. The data shows 32% of doctors and almost 27% of nurses in England are non-British.
So the economy is relying on this inflow of people to mask the domestic labor shortage and that health crisis we just talked about.
But you can't depend on that inflow while your political rhetoric is becoming more hostile to it. It creates this impossible tension.
And we're already seeing the results of that tension, aren't we?
We are. In 2024, there was a 26% increase in the number of foreign-trained doctors leaving the UK. They risk losing their status as a top destination for global talent, which puts the whole system in jeopardy.
So if you had to synthesize everything we've discussed, the zero growth, the debt, the capital strike, what are the three most severe structural weaknesses facing the UK right now?
For me, if I'm looking at vulnerability to future shocks, it's these three. 1. Extreme fiscal fragility. That 4.7% gilt yield means there's just no margin for error.
Okay, what's number 2?
The labor force health crisis. That 2.8 million people inactive due to sickness is a unique problem among the G7, and it's a massive chronic drain.
And number 3?
Has to be the chronic investment deficit. That capital strike is what condemns the economy to a future of low productivity and therefore low real wage growth.
And the sources lay out 2 possible paths from here. The first is the inertial scenario, which sounds like, well, more of the same, a slow decline.
That's the base case. Continuing with 1% to 1.5% growth, relying on migration to keep the economy from shrinking, and just a gradual decline in global influence compared to the US or the EU.
And the alternative is much worse, the crisis scenario.
Yeah, they use the chilling term slow Argentinization, a future characterized by social conflict, irreversible capital flight, and, eventually, forced austerity.
So with that, we're at the end of this deep dive. The UK isn't in a recession, but it is absolutely stuck. The growth is nominal, prosperity is stagnant, and the foundations are all deteriorating.
The fix isn't about small technical tweaks anymore. It needs a huge, credible strategy to break that capital strike and fundamentally rebuild the country's productive capacity.
Which brings us to the final, provocative question.
It's an identity crisis. The UK has to decide what it wants to be after Brexit. Will it pursue a soft alignment with the EU to reduce trade friction, a sort of Norway Light model? Or will it go for aggressive deregulation to become a low-tax global hub, the Singapore-on-Thames idea?
And until that's resolved.
The inertia scenario, that slow decline, seems inevitable, because right now indecision is its own policy, and it's a very damaging one.
It concludes this deep dive into the UK's fragile stasis. We hope that you learned something new today.
Thank you very much for joining us. We will meet again very soon.
Remember that in the description of this video, you can find PayPal if you want to help us. Thank you once more. We wish you a good start to the new year, and we will see you in 2026.